ladies and gentlemen, welcome once more to FT Headquarters. I'm Yuri, Editor of Professional Wealth Management. I'm delighted to introduce to you today Didier Duret, Chief Investment Officer at the Private Banking Division of ABN Amro. Today, we will discuss investment themes and trends for 2013, the type of companies we should be investing in, which regions are favoured, and the looming dangers which can be lurking in the background. Didier, from what I hear about your bank, you seem to be having a relatively positive view on equities. Having examined historical patterns of economic behaviour, is it really the case that after a time of recession, of crisis and belt tightening, that we normally see a reinvention of growth, a cyclical uplift in manufacturing?
I think the manufacturing is a key cornerstone for the economic wealth created by the global system. And I think we see many multiples coming out of the manufacturing, and we can expect also multiples for the investor. So I think the current configuration is certainly positive for a cyclical uplift, because simply last year we finished the year with the first sign that the manufacturing cycle is turning up, in particular in Asia, but also as well in the United States. What is interesting is that the manufacturing sector is at the cornerstone of the fact that we are seeing new innovation just coming into the market, but also that the demand is very new. There is new demand for more quality products coming from emerging market. The market is more fragmented. For instance, if we look at the mobile telephone, we have 1,100 different type of mobiles. So meaning that it's highly fragmented. So we need to manage that, meaning that we need to be more fluent, more agile in doing and managing the manufacturing sector. But there is a cyclical uplift that is really supporting this.
Didier, is it just the European companies that you're identifying that are playing in this sphere, or are they going broader into the emerging markets in the Far East and Brazil as well?
If we look at Korea, for instance, Korea is the #1 country in terms of industrial productivity globally. So there is really something going out. So it's not a divide between emerging market versus developed markets. The manufacturing renaissance is touching every country, as long as there is innovation, proximity to innovation, and also the ability to distill the innovation into the industrial process. We see new technologies. For instance, when you look at the lighter materials like the graphite materials, it will change totally the way we build cars in the future. It will also change the way we, for instance, package the food with the nanotechnology. We will be able to trace all the elements. So there are a lot of innovation. It's a global phenomenon. It's not only Europe. European companies are certainly benefiting from it. If you look at, for instance, BMW, the car industry, they are benefiting from the new power mechanism that we will build in the future that will be lighter and more energy efficient. But for instance, Germany is very strong in robotics. That's one of the regions where you have the highest rates of robot per unit of output.
So can we name a few more names here, Didier? These so-called masters of manufacturing, who are they? Investors need to identify these groups.
We can separate two groups. One of the groups who are just, let's say, engineering the renaissance. If you look, for instance, at companies like Emerson Electrics in the US, they are very specialized in automation. This is an example of the companies that are really doing all the robot and the automation system. ABB in Switzerland also is very strong on that. And you have, on the other hand, the companies that are benefiting from that. You can have BASF, you can have companies that are into the packaging business, Laxness, but also into the verification business, Intertek, for instance, in England, or Veritas in Bureau Veritas in France.
And what do these companies have in common in terms of valuations or dividends or their international reach, the structure, the culture of the company?
An important element is openness to innovation and really having the strong will to put it into the process. And in terms of valuation, the valuation of the companies varies between, let's say, 8 to 20, but the big bulk of these companies are moderately valued in line with the market, around 12, 13. What is important is that they have long-term growth between 10 and 20%, which is in an environment where we see, recessionary forces extremely appealing for the investor, meaning that the risk premium is rather strong and that there is a strong chance to serve dividends between 3 and 4%.
And how should investors access these opportunities? Would it be through direct investment in the stocks? Would it be through the bonds these companies issue? Would it be funds? Would it be the good old structured products which private banks have controversially loved so much?
I think the easiest way to get into this industrial renaissance is probably to go into the large cap, because they represent a diversifying power, they have a global scope, and it's probably easier for the investor to select these companies that have already made the selection and the relevance of all this innovation into the process than to select one company that is doing robot in Japan or in
So you're talking about large cap funds?
Yes. It's large cap funds, but it can be large cap companies also, because the small companies investing in small companies represent a higher risk, lower diversification, and let's recognize it. The investor is pretty reluctant to take a lot of risk these days, so it's better to already go into diversified instruments.
And which are the main risks that are still looming in the background? The fiscal cliff issue, I mean, it hasn't really been 100% solved yet, and we've got the euro rumblings still going on. Should investors really be concerned about these things?
We are simply managing this risk. I think this risk were really the risk of last year, but 2013 will be certainly more about the growth potential, how we will be able to rebuild the condition for growth, and that's let's say the area where the investor should focus on. Let's face it, the bonds are very expensive at the moment. They can provide only a limited return, and there is the potential of all these companies that have rather flat margin for several years. It's unprecedented to have seen industrial companies preserving the margin in a recession, and what had happened. And I think they are still cheap, and they represent good opportunities to serve dividends that will be higher than the bonds anyway.
So many private banks are trying to convince their clients to move to less liquid opportunities, to tie their money up for a longer period of time. But you seem to be saying that might be the wrong approach. Now's the time to invest in the more liquid opportunities. Is that really the case?
The liquid assets were simply punished by the macro risk, the systemic risk, but now I think they represent the advantage of being liquid, diversified, and more apt to attract investor now, considering also the risk premium that we have on equities, for instance. The less liquid assets, they were representing a good alternative when the market conditions were very adverse, because you can go over the hill in some ways, but now it's not necessary. We are probably seeing a cyclical recovery, and it's time to consider the companies that are the main players into this cyclical recovery.
And what kind of asset allocation should we be talking about for equities, for this? Should this be at the core of investors' portfolios at the moment?
On a diversified portfolio, balanced portfolio, I think it's important to be overweight equities at the expense of bonds, meaning that you have, for instance, 40% in equities versus a benchmark of 30%, and to have less bonds, and to have, for instance, in our balanced portfolio, we have almost zero cash position. And the two pillars of the asset allocation are really equities and bonds. The alternative investment into the real estate, we are also overweight into the real estate, overweight also in hedge funds, but we are definitively lower into cash and bonds.
Didier, you've been making these predictions, delivering these kind of themes for many, many years. Why are you so convinced that now is the time for this new renaissance when people around us are still coming up with very negative thoughts, with negative research, but you're in a very positive frame of mind at the moment about economies, about companies and their prospects.
Yes, indeed. We believe strongly in the thematic investment because it helps the investor to go beyond the problems that are connected with the benchmarks. For instance, if you only look at the sector breakdown when you want to invest, you will have a lot of difficulties, because if you really want to do it, you have to have a lot of granularity in terms of selection. You need to go into the subsector, you need to go into the individual companies. But we prefer to go straight into the thematics and select the companies that are fitting the thematics across sector. So it makes more sense with the new reality that we are facing when we consider, for instance, the renaissance in manufacturing is one theme, but also we have the global, let's say, energy revolution that is really happening now. So you need to play that also in a certain number of ways, by also buying the companies that are benefiting from this revolution. So I think it's better to be plugged to the fundamental ideas, and the thematics is the best way to capture the fundamentals.
Well, Didier, hopefully we can meet again at this time next year and see how successful some of these themes and predictions have been. Thank you very much.
Thank you.